Today, smoke, mirrors, and hopium haunts markets seeking certainty. Hello again, it's Martin North from Digital Funds Analytics. Welcome to this post covering finance and property news. This is our weekly market update where we start in the US, across to Europe and Asia, and into Australia, covering commodities and crypto along the way. Whilst world markets traded on a relatively solid footing this week, with the MSCI Global Index up 0.14% on Friday, it was down 0.26% across the 5 days, and the European Stoxx 600 was up 0.29% for the week and 10.5% over the last month. It's all not really that convincing. Sure, we had a grand announcement of a trade deal, quote unquote, between the US and Britain, correctly described by one trade expert as a nothingburger of a deal. Trump urged investors to celebrate. You better go out and buy stock now, he said. Let me tell you, this country will be like a rocket ship that goes straight up. Is he qualified to give financial advice, I wonder? It was positioned as what could be the first of dozens of trade deals in the coming weeks, and there are talks about talks this weekend between the US and China in the Swiss town of Geneva, though it's not clear who blinked first. India offered to slash its tariff gap with the US to less than 4% from nearly 30% now, in exchange for an exception from current and potential tariff hikes. That's according to Reuters. And Trump said that setting 80% tariffs on Chinese goods seemed right. It was his first suggestion of an alternative to the 145% levies that he's imposed. Frankly, the trade deal with Britain will not inspire much confidence that this mess is over. It would be generous to even describe the UK deal as a limited preliminary agreement. Notably, it left the 10% tariff against one of America's greatest allies in place. Imagine what US President Donald Trump, who insists that he has the final say on tariff rates, will do to countries he doesn't like. Once the dust settles and deals are reached, tariffs will be lower than those proposed on April the 2nd, perhaps significantly lower, but the fact is they will still be significantly higher than they were before Trump entered office. He pushed back against the idea, by the way, that the UK deal could be a template for other trade negotiations. The ASX ended flat across the week, post the election, of course, and it'll be one of the first markets to trade on Monday morning on news coming out of the first round of trade talks between China and the US in Switzerland. Will investors be celebrating the beginning of the end of the trade war drama, or yet another shock? We will see. The S&P 500 and Nasdaq were back where they were on April the 2nd, recovering the 15% losses in the days immediately after Liberation Day, when Trump unveiled his reciprocal tariffs. Germany's DAX is at new highs, and Japanese stocks sealed their best weekly winning streak in over 2 years. The S&P 500 index jumped 1.3% at one point, but then ended the session up just 0.6%, and it may be a sign that investor confidence in tariff deals, which has driven the staggering rally in Wall Street over the past month, may be starting to fray just a little. In cryptocurrencies, by the way, Bitcoin eyed its 4th straight day of gains, touching its highest level since January after Thursday's advance, which was the biggest in a month. On Friday, Bitcoin gained 0.58% to $103,600, while Ethereum rose 6.7% to $2,379. Sentiment was boosted by a sweeping raft of stimulus measures from China, including interest rate cuts and liquidity injections. And the Bank of England also cut rates this week, and the Bank of Japan looks to have put its tightening cycle on ice. Fed Chair Jerome Powell highlighted ongoing uncertainty about the impact of trade policy on the economy as the US Central Bank held off from a further rate cut this week, saying they will wait to see the data incoming. See my earlier show on this. On the earnings side, 450 companies listed on the S&P 500 have reported first quarter results. Earnings growth has been running at around 14%, although negative projections for the second quarter have outstripped positive forecasts by almost 50%. All up, uncertainty remains the watchword, which means markets will overreact to any news, good or bad. That said, the fear gauge was down to 21.9. That's a drop of more than 41% over the past month. On Wall Street, the Dow fell 0.29% to 41,249. The S&P 500 fell 0.07% to 5,659. And the Nasdaq Composite fell to 17,928. For the week, the S&P 500 fell 0.5%, the Dow lost 0.2%, and the Nasdaq slipped 0.3%. In currencies, the dollar was down on the day, but eyed a weekly gain against major currencies, including the Swiss franc, yen, and euro, on optimism about upcoming US-China talks. The dollar index, which measures the greenback against a basket of currencies, including the yen and the euro, fell 0.29% to 100.35. The euro was up 0.25% to 1.1249, while against the Japanese yen, the dollar weakened 0.42% to 145.37. Sterling strengthened 0.45% to 1.3306, whilst against the Swiss franc, the dollar weakened 0.12% to 0.831. US Treasury yields were little changed, with thinner volumes than usual and sentiment still uncertain as investors looked ahead to talks between the US and China. The yield on benchmark 10-year notes rose to 4.382%, the 30-year Treasury rose to 4.8439%, and the 2-year note yield, which particularly moves in line with the Federal Reserve interest rate policy expectations, fell to 3.895%. Oil futures rose more than $1 on the day and notched their first weekly gain since the middle of April, as investors were hopeful ahead of trade talks between US and China. They're, of course, the two biggest consumers of the commodity. US crude settled up 1.85% to 61.05 a barrel, and Brent rose to 63.91 a barrel, up 1.17% on the day. The early days of the Trump 2 administration suggests that spending has not been reined in at all. Indeed, it is higher than it was under the Biden administration. Morgan Stanley economists this week said that they expect the 2026 budget deficit to be 7.1% of GDP, up from 6.7% in 2025. That would be an increase of around $310 billion. Numbers like that could unnerve investors and put added downside pressure on long-dated treasuries or yields higher. Gold rose around 3% across the week to $3,330, while the London Bullion Market Association said on Thursday that gold held in London vaults totaled 8,536 metric tons at the end of April, up 0.6% from the previous month, as more of the precious metal returned from New York to London after the earlier dislocation. The premium of the most active COMEX gold futures over London spot prices has normalised in April, when the Trump administration excluded the precious metal from broader US import tariffs after being evaluated for months. Market players had increased gold deliveries to the US in the December to March period to cover their COMEX positions against the possibility that the US would impose tariffs on those imports. There were also 22,859 tonnes of silver held in London vaults in April. That's up 3.3% from March, according to the LBMA. Silver holdings in London rose for the first time since October 2024, and silver was up 2% across the week to $32.89. European equities rose on Friday as the new US-UK trade deal offered hope that it could provide a framework for agreements elsewhere, lessening global trade tensions. The DAX index in Germany reached a new high, and the CAC 40 in France both gained 0.6%. The FTSE in London rose 0.3%. This has been a week of heavy issuance of corporate results, and there were more to digest on Friday. Commerzbank reported a net profit increase of nearly 12% in the first quarter, defying expectations of a drop, as the German lender attempts to fend off a possible takeover by Italy's Unicredit. Mediobanca posted a €1 billion net profit in the first 9 months of the Italian lender's fiscal year, driven by broad-based revenue growth and strong capital generation. A Norwegian industrial investment firm, Aker, reported a hefty profit for the first quarter of 2025, supported by gains from asset sales and dividend income. The Bank of England rate setters voted 5-4 in favour of cutting borrowing costs by a quarter percentage point to 4.25%. But two Monetary Policy Committee members voted for the bigger half-point cut, and a couple wanted to keep rates on hold. The Bank of England said that it thought tariff increases by the US and other countries would trim British economic growth and push down on inflation, but stressed the outlook was unclear. The Bank of England has now cut interest rates by the same amount as the US Federal Reserve since the middle of 2024, but by less than the European Central Bank due to concerns about high wage growth as well as the risk of persistently above target inflation. The Bank of England said it was not on a preset path for rates, and it also said that the impact of global trade tensions should not be overstated. And Bailey told a press conference that interest rates are not on autopilot. They cannot be. Instead, the MPC must continue to respond carefully to the evolving economic circumstances. Based on the situation as of April 29th, the Bank of England estimates the US tariffs would lower British inflation by 0.2 percentage points in 2 years' time and reduce the size of the economy by 0.3% over 3 years. The Bank of England said about 2/3 of the damage it forecast to British growth was the direct impact of tariffs in reducing demand for British exports in the US and elsewhere, while the remainder reflected the impact of trade policy uncertainty in lowering global growth. It sees inflation back in its 2% target in the first quarter of 2027. That's 9 months earlier than it forecast back in February. And the Bank of England Governor Andrew Bailey said the UK should work to rebuild its trade ties with the European Union, telling the BBC that stronger trade with the bloc would support the country's economy. His comments come ahead of the UK-EU summit scheduled for May the 19th, which is expected to include discussions on deepening defence cooperation and potentially easing trade barriers. The trade deal struck between the US and the UK on Thursday does leave room for Britain to pursue a veterinary agreement with the EU, potentially aligning standards to ease post-Brexit checks on food, agriculture and fish exports. Most Asian stock markets climbed on Friday, led by Japan, as the new US-UK trade deal framework sparked hopes for tariff negotiations with other countries, especially China. Investors also assessed China's monthly trade balance data to assess the impact of the hefty US tariffs. Japan's Nikkei 225 index jumped 1.5%, while the Topix was up 1.3%. A weak yen against the dollar also provided support. The Nikkei Volatility Index was down 5.76% to 2458. South Korea's Kospi was largely unchanged. China's Shanghai Composite Index fell 0.3%, while the Shanghai Shenzhen CSI 300 declined 0.4%. Hong Kong's Hang Seng was down 0.4%. China's exports topped forecasts in April, buoyed by demand for materials from overseas manufacturers who rushed out goods to make the most of US President Donald Trump's 90-day tariff pause. Outbound shipments from the world's second largest economy rose 8.1% year-on-year in April, while imports fell 0.2%, pointing to improving domestic demand as policymakers continue to take steps to prop up the $19 trillion economy. The data showed resilient domestic demand and foreign demand despite tariff headwinds. The figures were also likely supported by mutual tariff exemptions on key goods like electronics. Indian equity markets fell sharply on Friday amid escalating tensions with Pakistan following a series of cross-border drone and missile exchanges. Nifty 50 slipped more than 1% on Friday. The current hostilities, some of the worst between the new nuclear-armed neighbours in decades, are related to a deadly attack in India's Kashmir region in April, which New Delhi blamed on Pakistan. As both nations exchange accusations and military actions, international calls for de-escalation have intensified, with the US and the EU urging restraint to prevent further conflict. The Australian share market notched up its first weekly drop since early April, as a rebound in bank shares on Friday fell short of reversing the week's steep losses. The ASX 200 climbed 0.5% to 8,231. However, the exchange slipped 0.1% over the week, driven by a sell-off in banks following lacklustre results from Westpac and ANZ. 9 of the indice's 11 sectors were in the green on Friday afternoon, with banks and technology leading the gains. Bank shares were bolstered by the risk-on sentiment. Macquarie reported a near 6% rise in its full-year profit. The bank shares jumped 3.8% to 203.31. Commonwealth Bank lifted 0.9% to 167.04, while ANZ headed down to buck the trend. Energy shares rallied, with Woodside Energy advancing 1.4% to $20.40, tracking higher oil prices. Miners ignored the rebound in iron ore futures, with BHP down 1% to $37.54. Iron ore in Singapore was last at 97 US. In corporate news, CoStar struck a deal to buy real estate classifieds platform Domain Holdings for $3 billion after months of negotiations. Domain, majority owned by Nine Entertainment, rose 3.1% to $4.38, and Nine jumped 6% to $1.58. Helios posted the biggest loss, diving 25% to $1.16 after the healthcare stock went ex-dividend. And REA Group edged down 2% to $244.97 on news of Domain's deal, and despite posting an 18% jump in commercial revenues in the 9 months to March. And Chrysos Corporation surged 17.9% to $4.87 after inking a deal with the world's largest gold miner Newmont to deploy its mineral analysis tool across Newmont's operations. Now, it seems that investors have welcomed signs that corporate Australia held up well during the first months of US President Donald Trump's trade war and are betting that domestic-facing stocks will propel the share market higher as the Reserve Bank prepares to resume its easing cycle later on. At this week's Macquarie Australia conference, where nearly 120 companies presented, investors welcomed the stability offered by Labour's landslide election victory and looked at the boost from another interest rate cut by the RBA on May the 20th. Domestically exposed companies are holding up okay and are sheltered from what's happening globally, but those that are exposed to the US are a lot more hesitant, according to Matthew Kidman, the Centennial Portfolio Manager. Traditional healthcare stocks like CSL that have huge exposures to the US, while Trump is still busy looking at the pharmaceutical sector, are not as defensive as they used to be. The high-flying bank sector was dealt a reality check amid signs that persistent competition is squeezing margins. All the big four retail banks have now delivered earnings reports for the first half. The average net interest margin, that's a closely watched indicator of bank profitability, declined 1 basis point compared with the second half of 2024. The major banks reported a combined profit after tax of $15.5 billion, up 3.5% compared with the first half of 2024. National Australia Bank, the nation's biggest business lender, said it was facing mounting competition in that lucrative segment. ANZ is fighting off rivals in retail banking, and Westpac identified Macquarie as its main competitor in mortgage lending. Westpac and ANZ posted first-half profits that missed analyst expectations, weighing on sentiment across the sector. The ASX 200 Banks Index actually tumbled around 2% across the week, but it's still hovering just below record levels. The problem the banks have is they're historically expensive, so a bit of movement in their result either way is going to move their share price. There was near universal agreement at the Macquarie conference that Prime Minister Anthony Albanese's unexpectedly thumping election victory has provided stability to corporate Australia. Origin Energy reported a 300% spike in battery inquiries after Albanese said last month that he would spend $2.3 billion to provide 30% rebates on household battery systems from July this year if re-elected. Macquarie analysts noted that Labour's housing policies, alongside the RBA rate cuts, could boost housing stocks, including Mirvac and Stockland, and consumer-facing companies such as Wesfarmers and JB Hi-Fi. Finally, in crypto, Robert Kiyosaki, the famous investor and financial educator advocate, also known for his popular book Rich Dad, Poor Dad, addressed the cryptocurrency community with a new Bitcoin message in the light of recent events that threaten to give both the US and Japanese economies a hard blow, saying Bitcoin is still your defense. He's warning the US population as pilots say, strap in tight and prepare for a crash. Kiyosaki believes the current trade wars ignited by Donald Trump are dangerous and may lead to actual military conflicts in the future, mentioning that he himself took part in the Vietnam War twice and cursing any war as human insanity at its worst. In any case, he believes that when it comes to the economic side of the current or any future market turmoil caused by greed, insanity, and fear, gold, silver, and Bitcoin are still your defense. The general crypto story that the public finds so engaging is actually quite compelling. Technology and its unlimited power, unless something trips over the plug, art and design and meme-centric creativity combine to theoretically set one free from the tyranny of the central banking system and the trampy debt notes of currency at its core. But understand that you are speculating, not really investing. Gold, on the other hand, is a long-term marker and tracker of monetary value. It will spend years, sometimes not doing very much at all. Then, in a phase like today, its price validates its promoters and their fans. This is perhaps some insurance at least, but who really knows? Truth is, volatility will halt the market in the weeks ahead, and stocks will remain largely in overvalued territory. So time will tell what will happen from here. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.